So the first paper we're going to do is May 2024. On the 1st of November 2023, J. Jones Enterprises had cash in hand. And the business also had a bank overdraft. So you already know there's going to be a cash book. During November, the following transactions occurred. They gave us the transactions and they asked us to record it using the 3-column cash book, right? Am I posting it on YouTube? Yes, I am posting it on YouTube. So when you're doing a cash book, the first common mistake a lot of people make, they forget their balance brought downs. If you get a cash book tomorrow, the first thing I want you to look for is your balance brought downs. Cash in hand balance brought down will always be on the debit side. No exception. It will always be on the debit side. Bank overdraft, however, it will be on the debit side unless it's a bank overdraft. Then it will go to the credit side. So in this instance, it's a bank overdraft, meaning we spent more money than we had in the bank. So we now owe the bank money, so it goes to the credit side. So let's take a look, right? Give us a form to do the 3-column cash book on. First thing I did was put in the balance brought downs. Come on, page, you could do it. Load up. All right. First thing I did was do the balance brought downs. I put the cash on the debit side, and I put the cash on the debit side and the bank on the credit side because it was a bank overdraft. All right. Let's just see if we can read sideways for a little bit. Then they had the transactions. For the cash book, if it gets in money, what side does it go on? Debit side or credit side?
Debit.
Debit. And if you're spending money, it goes on the
Credit.
credit. So that's all you're asking yourself. Ignore all the other double entry rules when you're doing the cash book. I don't want you to mix up yourself. Although you're thinking sales is always credited, so I'll put this on the credit side. This is not the sales account, this is the cash book. All you are thinking, if I get money, put it on the debit side. If I spend money, put it on the credit side. So sales by check, 2,635. If I sell something, I getting money or spending money?
Getting money.
Getting money, so it goes on the debit side. Then you check if it's cash or bank. Once it's check, it means bank. So on the debit side here, I would have November 4th sales, and I have the amount under the debit side. On the bank, sorry, on the debit side. Then we had paid the following accounts, less 5% discount by check. L. Smith 840, K. Peters 920. We are paying money, so it goes to the credit side. Yeah? Everybody following that?
Yes, sir.
The next mistake people make, when it's time to record the discount, they put the percentage. They do not calculate it. Please don't let that be all. Please calculate your discount and put the dollar amount in the cash book. Do not put the percentage. Please, I beg of thee. I beg of you, do not do that, right? A lot of people do it. We're not going to do it. We know you have to put the dollar value. The next one, B. French paid $1,900 in cash, so they told us how much he paid in full settlement of his account of $2,000. B. French is paying money to us. Are we getting money or spending money?
Getting money.
Getting money. So it goes on the
Debit.
debit side. But here's the heights. He paid $1,900 and it's in full settlement of his account of $2,000. How can 1900 cover 2000? What had to happen?
You get $100 discount.
Get a $100 discount. So we have to record that $100 discount, right? So that's why we come here. We put his date, his name. We put $1,900 under cash because that's how we paid it. And then we put the $100 discount in the discount column. Everybody following still, right?
Yes.
All right. Next one. Cash sales paid directly into the bank total 1,125. Now, yes, it is a cash sale, but because they put it into the bank one time, we are going to record it under the bank column. So once it's a sale, we getting money or spending money?
Getting.
Get
So it
money.
goes on which side?
Debit side.
Debit side. Oh, you see how much food Cashbook is? Cashbook is real food. So we record sales and we put the amount under the debit side. On the debit side on the bank. Because it was check. Because it was paid directly into the bank, sorry. Next one. Mr. John. Nelson Warren John, sorry. The owner gave the business 3,000 by check, which must be repaid within 1 year's time. If they have to pay him back, what would that be? What do you call that? If I give you money and you gotta give me back, I just gave you a what? Start with L,
A loan.
a loan. So you could record that details as a loan. November 19 loan, $3,000 under the bank column. Next one. The owner took $800 of the cash in hand to deposit into the business bank account. So if I'm taking money from my cash in hand, I'm putting it into the bank account. And it affecting both cash and bank? What kind of entry is that?
A Contra entry.
A contra entry. So make sure you put a small c in the folio or next to your description. One or the other, right? So come here. I'm taking 800 from cash in hand. So my cash in hand gonna get credited. So on the credit side, hey, stop scrolling. On the credit side, what is thing going on? So right, I'm gonna have $800 under the cash column, and the details will be bank, the opposite account being affected, and I'm putting it into my bank. So I'm gonna debit bank. On the debit side, I'll put 800 under the bank column, and the details will be cash. The details is always the opposite account being affected. And then I put the small c for the contra entry. Last one, paid rent, cash total $1,540. For paying rent, that means I'm spending money, so I credit. And it's cash, so I'm putting it under the cash column. Rent $1,540. Now for the folios, how do I get these folios? Simple. I can make it as easy as I possibly could, right? If it's not a person, if the details is not a person or a business, let's say the details is sales or rent or insurance or furniture or computer, it is not a person or business, the folio is GL, General Ledger. Once it's not the name of a person or the name of a business, the folio is GL. If it is the name of a person or the name of a business, and it's on the debit side, then it's SL. If it's on the credit side, then it's PL. Reason being, when we sell something, we pay it on it, we get in money, we pay it on the debit side, right? So all the debit side of the cash book will be based on sales. So once it's a person or a business, they would have been a debtor, they would be in the sales ledger. On the credit side, that will be related to payments, to things that we're paying for or buying or purchasing. So once it's on the credit side, it will be related to a creditor or payables. So it will be in PL. You don't have to remember all that. Just remember, if it's not a person, the folio is GL. If it is a person, debit side SL, credit side PL. And that is it. All right? After there, we're going to do our balance carried down and our balance brought down. Discount columns do not have a balance carried down and brought down. You're just going to put the totals. It could be different. That's okay. Right? You'll do your balance carried down and you brought down for your cash and bank columns. Right? You check to see which side smaller. We see the debit and credit side. You go to the smaller side. You calculate your balance carried down by adding up the larger side and minusing the smaller side from it. And I say you get balance carried down. You do that for both cash and bank. You pay your totals. Your cash total should be the same. And your bank total should be the same. Then you pay your balance brought down on the opposite side of your carry down. And that is the cash book completed. All right, I'm going to do the banner break our next anymore. All right. The following information is available for John Enterprise for the month ended 31st of December. As soon as I see balance as per bank statements, I know there's going to be a bank reconciliation question. So the balance as per bank statement, 9,275. Check number 103 for 1,233 and check 107 for 830 were not shown on the 31st of December, which means they were not presented to the bank. Those would be unpresented checks. And a deposit of 2,270 made on the 31st of December does not reflect the month-end bank statement. That's a late lodgement. A deposit made too late to enter into the bank statement. So they want us to do the bank reconciliation statement for the month ended to arrive at the cash book balance. So we're not starting with the cash book balance, we ending with the cash book balance. Bank reconciliation is normally revise cash book balance, add unpresented checks, minus late lodgements, and that would give you a bank statement balance. So you start with the cash book, add unpresented checks, minus late lodgements, and that gives you the bank statement. In this case, they wanted to start from the bank statement. Whenever you're starting with the bank statement balance, you have to do the opposite. So instead of adding unpresented checks, you'll minus unpresented checks. Instead of minusing late lodgements, you will add late lodgements. So it'll be balance as per bank statements, add late lodgements, which will be the 2,270, minus the unpresented checks, which will be the 1,223 and the 830. And that's supposed to give you a cash book balance. All right, so this is how it looks here. And that is the first one, which was 20 marks. Wasn't too bad in my humble opinion. Banana. Right. Number 2, they asked us to state one advantage of a limited liability company. It could raise a huge amount of capital and it have an advantage just in the name itself, right? Limited liability companies have limited liability, or at least the owners have limited liability. Disadvantage, It's harder to set up, or more complicated, I should say. You have more fees and taxes, and you have a less personal touch with customers. Then they said, in May 2023, Rosedale Company Limited sold the following shares and debentures to increase its liquidity. $180,001 ordinary shares, 100,000 8% preference shares, 150,000 5% debentures. And the biggest difference here is the debentures. Debentures do not give you ownership of a company. Debentures, you are selling debt, DEBT. So, in layman's terms, it come like people are giving you a loan and you have to pay them back with interest, regardless of whether or not they're making profits. They do not get any ownership in the company. Right? Ordinary shares and preference shareholders give you ownership. Preference shareholders are not allowed to vote, but they get paid before ordinary shareholders. Ordinary shareholders are allowed to vote, but they get paid last. Preference shareholders, the percentage that they get in dividends stays the same. Ordinary shareholders, it varies based on how well the company does. The debenture holders get paid before both of them. So the first thing what they ask us to do is to record the issue of shares and debentures in the journal. You're recording it just like you would in any journal, right? We know assets when they increase your debit, capital when it increases your credit. So we put in money in the business bank account, $180,000. We're gonna debit bank $180,000. The ordinary share capital is increasing. When capital increases credit, we will credit the ordinary share capital. They said narrations are required, so we put a small description of what the transaction was at the end of it to record the issue of ordinary shares. Then we repeat the process with the preference shares. You debit your bank 100,000, credit your preference share capital to record the issue of preference shares. Then we have the debentures. Debenture is a liability. When liabilities increase your credit. So it's basically the same thing again. You're going to debit your bank, credit debentures. Pay your narration to record the sale of debentures. And that is 8 marks right there. Easy. Food. In my humble opinion. Then it asks us to get one ratio that calculates the liquidity of the company. You could use working capital here, that would be accepted. You could use quick ratio, you could use current ratio, those will be accepted as well. Then they ask, calculate the total annual dividend payable at the end of the financial year for the transaction on the 10th of May. That is the preference shares. Now, the thing with the preference shares, remember I said that the dividends that you pay to preference shareholders is fixed. It's so fixed that it's in the name. 8% preference shares. Is 100,000 $4 preference shares, which means each one of those 100,000 shares is $4. So it's $400,000 in total. And they're gonna be receiving 8% of that 400,000 in dividends. So I'm gonna take the 400,000 multiplied by 8%, and that is the amount of money they're receiving in dividends, 32,000. 2 marks. And they come here, calculate the total annual amount payable for the debenture interest expense at the end of 1 year. Again, they have it in the name. 150,000, 5% debentures. Every year, they have to pay 5% interest. So it's going to be 150,000 multiplied by 5%. 7,500. Another 2 marks. Then they said, okay, stop scrolling. At the end of the year at the end of year operations, Rosedale Company Limited calculated a net profit of $48,500 before debenture interest payments. Calculate the total amount available for paying dividends to ordinary shareholders. So, debenture interest has to be paid first. Preference share dividends have to be paid before ordinary share dividends, and then ordinary shares get paid. So that 48,500 before the ordinary shareholders could even look at it, we had to minus the 7,500 for the debenture interest, and we have to minus the 32,000 that we calculated before that preference shareholders have to get in dividends. So the money that remaining, ordinary shareholders could get from that. So that $9,000 that remain, those scraps, that's for the ordinary shareholders. Sometimes it pays to be an ordinary shareholder, sometimes it doesn't. There you go. Then they said, calculate percentage return on investment for ordinary shareholders. All right. This formula is net profit divided by capital multiplied by 100. Return on capital is net profit divided by capital multiplied by 100. In this case, they want specifically ordinary shareholders. So we're going to look at net profit divided by ordinary shares multiplied by 100. First, we have to get our final net profit figure. Debenture interest is an expense. We have to minus it to get our final net profit figure. So it'll be 48,500 minus 7,500, which will leave us with 41,000. And then we dividing that by our ordinary share capital and multiplying by 100. And that's how I got the 22.78%. Just in case ratios come, make sure they know all your ratios, huh? Just in case it comes. I'm not saying it will. I don't have a crystal ball, I can tell, but just in case, prep for it, please. And that is number 2. 2 down, 3 more to go. You're following so far? You're following so far? Yeah, no, maybe. Yeah? All right.
We go inside or
All right, good. Number 3, partnership question. Ban and J are partners, sharing profits and losses at a ratio of 3 to 2 respectively. At the end of the financial year, 31st of December 2023, the following balances were extracted from the books of a partnership. I remember this question. This was a solid question. This question is going to test your knowledge on income statements, and it's going to test your knowledge, well, adjustments, I should say, and it's going to test your knowledge on partnerships. So they gave us this information, and then here they gave us they said closing inventory had been understated by 3,500. And it said non-current assets are to be depreciated by 20% per annum using the reducing balance method. And the first thing it asks us to do is prepare the income statement for the partnership for the year ended 31st of December 2023, using the balances and the additional information provided. So I know, when you're doing income statement, it's going to start with sales, minus return inwards, net sales. I know and I understand. However, if the question gives you gross profit, please don't do that. Start from the gross profit. They get your gross profit, they get you a nice blind. You don't have to go to that sales, return inwards, net sales, opening stock purchases, card, none of those things. You get to start from gross profit, add the revenue, minus the expenses, get your net profit. Makes life a lot easier for you. But before we can start with our gross profit, we have an adjustment to make to our gross profit. Because closing stock is used in the calculation of gross profit, and they are saying that it was understated by 3,500. So we have to make an adjustment. What should we do with that 3,500? Follow me. No, we're going to take a little ride, but just follow the trailer thought, right? Right. Net sales minus cost of goods sold is equal to gross profit. Right? Everybody agree with that so far? Yeah? Yes, no, maybe?
Yeah.
Yeah? Right? Which means the bigger the cost of goods sold, the smaller the gross profit. The bigger the cost of goods sold, the more you're subtracting. So that means the smaller the gross profit. Increase cost of goods sold equals decrease gross profit. And vice versa is the same. Decrease cost of goods sold is equal to an increase in gross profit. All right, so we notice if our cost of goods sold increases, our gross profit decreases. If our cost of goods sold decreases, our gross profit increases. All right. Cost of goods available for sale minus closing inventory equals cost of goods sold. Cost of goods available for sale minus closing inventory is equal to cost of goods sold. Which means if my closing inventory is greater if your closing inventory increases, that means your cost of goods sold decreases. If your closing inventory decreases, that means your cost of goods sold increases. So in this case, our closing inventory was understated. So it decreased, which caused our cost of goods sold to increase. And when our cost of goods sold increased, it decreased our gross profit. So our closing stock being understated decreased our gross profit. So to fix it, we're going to add back that 3,500. I know it was a long ride, but I had to explain it before I just tell you add back the 3,500. So I had to add that 3,500. And I gave us our updated gross profit. Now we could add revenue and minus expenses. Although there does not seem to be any revenue, so we could just minus expenses. We have operating expense, 107,000. Then we have something that they love to do. There's this interest on loan. You ain't seen anything about interest on loan being paid here, but they mention it here. Interest on loans are an expense, and it is subtracted in the income statement to calculate the gross profit, the net profit, sorry. It doesn't matter if it was paid or not. Once it is meant for the year, we have to record it. So I have to calculate 8% of 25,000. That will be an expense to me. Then I have the depreciation. I'll have to calculate depreciation using the reducing balance method. That will be an expense to me. So I have it here, depreciation. I find out the net book value first, which is the cost of the asset minus all previous depreciation. And then I multiply the net book value by the depreciation rate of 20%. Now so we're getting 96,000. And then with the interest on loan is really just take the debenture and the debenture interest, which was 8%. Now we debenture I still in the last thing, yes? The interest on the loan was 8% and multiplied by the loan, which is 25,000. 8% of 25,000, 2,000. So now that I calculate all that, I just subtract it. So I have my operating expense, my depreciation, my interest on loan, add it up, get my total expenses, minus expenses from gross profit, and that gives me net profits. $82,500, and that is 9 marks. Now the next part is probably the appropriation account. So that whole thing was 9 marks. Then they asked us to prepare the appropriation account for the partnership. If a partnership question comes, and you have to do the appropriation account, all appropriation accounts, company accounts, partnership, we all start with net profit. In the partnership, you have 3 adjustments to make. Only 3. You add in interest on drawings, not drawings, interest on drawings. You're subtracting interest on capital, and you're subtracting any salaries or bonuses. Those are the 3 adjustments you're making. So you'll head it up, name of the company, profit and loss appropriation account, for the period ending, for the date and so forth. And then start over the net profit, 82,500 that we calculated. And then you're going to add the interest on drawings. They gave us the figures. So you didn't have to do anything there, right? So we add our interest on drawings. Then we have two things to subtract. Interest on capital and salaries and bonuses, if any. They gave us the capital amounts and they said interest on capital was 3%. So we just calculate 3% of Band's capital, 3% of J's capital. Which is what we did here. Get the total, subtract it. Then J had a salary, $36,000. Now, sometimes they might give you the salary for the month. You would have to multiply it by 12 because the appropriation account is for the year. Or let's say the drawings was, you took out drawings, but only 5 months ago. The interest on drawings percentage is for the year. So you'd have to adjust it based on it being 5 out of the 12 months. So whatever it would normally be, you'd multiply it by 5 over 12. All right, so they give us our salaries, we minus it. The money that remains is the profits to be shared. So it's 36,200 is the profits to be shared. Right? Then we will share it based on the profit sharing ratio. Let's see what they said the profit ratio is 3:2. So we're gonna use this and get fractions. The 3 would be BAN and the 2 would be G. The 3 will be the numerator for BAN's fraction, and the denominator will add the 3 and the 2 together. So BAN will be getting 3/5. For J, the 2 would be the numerator, and the denominator again, you add the 3 and the 2 together. So J will be getting 2/5. So BAN will get 3/5 of the profits to be shared. J gets 2/5 of the profit to be shared. Which is what we did here. 3/5, 2/5. Then I add it back to make sure it's still adding up to 36,200. For some reason, all of this is only 6 marks. CSEC is extremely inconsistent with this. Sometimes this will be 12 marks, sometimes 5 marks. You just do it as it comes. Finally, for the remaining 5 marks, I think it is. The access to the current account, but for J only. So the current account, first thing you're doing when you do a current account is you're checking to see if there's a balance brought down. And it does have a balance brought down. We're doing it for J. J has a credit balance brought down. If they don't tell you if it's debit or credit, if it's a positive balance brought down, it goes on the credit side. If it's a negative balance brought down, it goes on the debit side, right? In this case, the ease is up. And there's 2 lush credits. So we'd start off with the balance brought down on the credit side. After that, any money that the partner is getting goes to the credit side. Say interest on capital, that is money the business paying to the partner. Salary, that the partner collecting. Share profits, All of those go to the credit side. Any money that coming out from the partner will go on the debit side. So the drawings and the interest on drawings will be on the debit side. Then you do your balance carry down and balance brought down like you normally do. And that's the end of it. That's number 3. Let's go to number 4. Number 4 is a forecasting question. Not that I think it will come, just it hardly ever comes. So a lot of people are not sure how to do it because they don't get much practice. So let's practice it just in case. Ariana manufactures a component which is used in the production of cell phones. Sales for the component for each of the first 3 months of 2023 as follows, are forecasted as follows. Forecasted means this is what they think they're going to sell. Jan to March, 15,100. April to June, 6,300. July to September, 6,760. Ariana has been operating with a policy whereby she maintains a closing inventory sufficient to cover 5% of her next quarter's sales. Ariana's forecast that sales in the last quarter of 2023 to be 8,880. Prepare the production budget for each quarter. So this is how you have to think, right? You're trying to think about how much do I need to produce for this quarter. That will be based on how much inventory you already have, how much you plan to sell, and how much you need to hold as closing stock or closing inventory. So for example, in January, Jan to March, you expect to sell 5,100. So you need 5,100 in sales. You need 5,100 units. So I'll start off with my forecasted sales 5,100. Then they said you have to have closing stock sufficient to cover 5% of next quarter's sales. So not only do I need that 5,100 from Jan to March, but I need 5% of next quarter's sales as closing stock. So I need 5% of this 6,300, which is 315. So that's the total inventory I'll need for the quarter, 5,415. Now the question is, did I have any opening stock? And the answer is yes. They said that you have to have closing stock to cover 5% of next quarter's sales, which means the quarter before this one, January to March, they would have had closing stock of 5% of this quarter's sales. So October to December, they would have produced enough to sell in October to December, and they would have kept 5% of 5,100 as closing stock. So in January, that would have become their opening stock, which is 255. So they need 5,415, but they already have 255. So the total that they need to produce would be the remainder, 5,160. Right? That is how you need to think for all of them. Same thing for quarter two. How much do I need in all? I need to have 6,300 for my sales, April to June. So forecasted sales 6,300. I need to have 5% of the next quarter's sales on hand. 5% of 6,760 is 338. So not only do I need 6,300, but I also need 338. So adding the two of them together to get the total inventory I'll need. But in the previous quarter, I had closing stock of 315. So in this quarter, that will be my opening stock. So although I need 6,638, I already have 315 in inventory. So all I need to produce now is the remainder, the 6,323. So I take in my forecasted sales, I add in my closing stock, and I subtract in the opening stock. And then the same thing for quarter three. Forecasted sales is 6,760. So I need to have 6,760. Then I need 5% of the total forecasted sales of the next period, the next quarter, which they said was 8,880. So I need 5% of that, which is 444. So I need the 6,760 from the forecasted sales plus the 444 to hold as closing stock. So in total, I need 7,204. However, I had a closing stock last quarter of 338, which means that is now my opening stock. So although I need 7,204, I already have 338. So I will be producing the rest, which is the remainder, 6,866. All right, so if you get a question like this, follow the rules that they put to a T. And you're checking your forecasted amount. You're checking the amount you need to sell that period, the amount you need, you're checking how much you need to produce, sorry. You're checking the amount you need this period. You're checking how much you need to keep as closing stock. And then you're checking to see how much you have already. All right, that was 7 marks. Then they said the selling price per unit during the budget period will be $8 per unit. How many units should Ariana plan to sell? And she wishes to achieve the revenue target of 45,000. I'm just going to take 45,000 and divide by 8. As each unit gives you $8. So this is correct. Right. Let's go into pass. And Ariana employed Celine Smith, a production worker. Selena is required to work a 40-hour week and is paid at a rate of $200 per hour. Where's Selena working by? Hours worked in excess of 40 hours are overtime and paid at a rate of time and a half. During the second week of April, Selena had worked a total of 44 hours. Calculate her gross pay. The gross pay would be her basic pay plus any overtime. Her basic pay is the 40 hours she's supposed to be work, multiplied by her amazing rate of 200 per hour. The overtime now, so I'll multiply 40 hours by 200. And then I'll calculate my overtime, which will be 4 hours, multiply by the 200, multiply by 1.5, because it's time and a half. If it was double time, I'll multiply by 2. So it'll be that 4 extra hours she worked because she works 40-hour shifts, but this period she worked 44 hours. So she worked 4 hours extra, that's the overtime. We're taking that 4 hours, multiply by 200. And multiply by 1.5. Alright, so you get 1200. Here now, for the month of April, Selena Smith just earned a gross pay of 32,200. The following details to be applied to gross profit. Well, that's national insurance deduction, income tax, monthly credit union contribution. Mm. 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 All right. Let's do this one first. Calculate the net pay, take any gross pay, and you just minus any deductions. National insurance is 5%. Calculate 5%. Income tax is 10%. 10% of the gross pay. And then you minus the $300 contribution. There is it. Nothing big. And you ask you to complete the following check. You put to it paid to. You put the sum of money. You put the numeral amount here next to the dollar sign and you sign. Date, you put the date. Easy thing. I remember this one. This is Probably the longest paper question ever see come for CSEC. They give you all these transactions, and you had to record it in the T accounts. Now, one thing in double entry rules, it's easy, just long now, boy. I was like, wait, boy, CSEC wicked, boy. So here's what we'll do. We'll just go through each transaction and see which accounts you're going to debit and which accounts you're going to credit, right? Following these rules. Assets, when they increase your debits, when they decrease your credits. Liabilities and capital are the opposite. When they increase your credits, when they decrease your debit. For all your other accounts, you follow the acronym PRIDE. PRIDE stands for purchases, return invoice, drawings, and expenses. Everything in PRIDE is always debited. Sales return out towards revenue, always credited. So the first one, the owner made a bank deposit from his personal resources. Whenever you invest money into in a business, what do you call it?
Capital.
Capital. The two things are going to be affected would be capital and bank. Both of them are increasing. Bank is an asset. When assets increase your debit, capital, when capital increase your credit. If you can't remember, but you could only remember one, so you know one of the accounts is debit. Whatever the next account you're using, that's going to be credit. The second one, we drew cash from the bank for business use. That affects both your cash and your bank account. You're taking money from your cash. Are you going to debit or credit? If you're taking money from your cash, you're going to debit cash or credit cash? Anybody?
Gotta credit it.
Mm-hmm. And if you're paying money in your bank account, you're going to debit or credit it? You're paying money in your bank account, so you would debit it. Simple as that. Even if you couldn't remember, once you know you have to credit cash, automatically means you're the debit bank. Proceeds from sales for the week with bank. Your bank increase, so you're going to debit your bank. And if you debit your bank automatically, what are you going to do to sales? If you debit bank, what are you going to do to sales automatically?
Credit it.
Credit it. Use the check to purchase a used van with extra spare parts. Use a delivery van and spare parts account. Sure. So I'll open a delivery van and spare parts account. And the next account will be affected if I use a check. Check means what account?
Bank.
Mm-hmm. If I'm spending money, am I going to debit or credit bank?
Credit.
Credit bank. So that means I will debit my delivery van and spare parts account. Hmm? This transaction, this question will take a while. To be fair, some of the other questions will not have taken as long. Bought inventory and credit from Rob Smith. The terms were 5/10 net 30, which means you'll get a 5% discount if you pay within 10 days, but you must pay within 30 days. Whenever you buy inventory, that's purchases. Purchases are always debited. Rob Smith, which is the next account, would be credited. Sold inventory on credit terms 2% net 10, 2/10 net 30, sorry. So SPTers means you get 2% discount if you pay within 10 days, but you must pay within 30 either way. Sales is always credited. So credit sales, which means what am I going to do to SPTers? If I credit sales, I'll do what to SPTers?
Debit.
Debit SPTers. Cash sales 3,600. If I sell something, I get in cash, so I'm going to debit my cash because my assets increasing. And then I'm going to credit sales because sales is always credited. Paid cash for petrol and servicing a delivery van. I'm paying my cash, so my cash is going to credit. And then I'm going to debit my motor expenses account, because that would be an expense. 21st, settled our account with Rob Smith in full. That was only 12 the purchase. And we settled it on the 21st. That's 9 days, which means you get a 5% discount. So you calculate 5% of 17,000, which is 850. So you're going to credit your bank account because you're spending money. Oh no, wrong place. Here, good. Right place. Credit the bank account because you're spending money, and then debit Rob Smith. You're also going to have to credit your discount received. So again, credit bank because you're paying in full with your checks. And then you're going to credit discount received. And then debit Rob Smith. Next one, paid cash. That's all I need to read. Credit cash for miscellaneous business expense. Debit business expense. Expense is always debited. Bobby paid his home insurance premium in cash. So credit cash, credit I spend money, but I spent it on myself for personal use. That would be called what?
Drawing.
Drawings. So debit drawings. Settle the business electricity bill by check. Credit bank. Debit electricity. As Peter settles his account on the 28th. When did he start? On the 13th. 13th to the 28th. It's way more than the 10 days, so they're not going to get any discount. You'll have to pay his full amount. 9,000. What else? Owner made a bank withdrawal for personal use. See what total 1,200 cash from the sale of some old spare parts and realize the profit of 200. And to here, I would receive total 1,200 cash from the sale some old van spare parts and realize a profit of $200 on it. That's it more or less, you know. The last one, you receive a total of 1,200 cash. Here, debit your cash. You credit the old van spare account 1,000 and you credit your the profit 200. The delivery van and spare parts. Letters were right. See? I put 1,000 because I know the 200 was extra. Now we get so that 200 I'm gonna put it as what was it again? Or revenue. Revenue gain on the sale of delivery van and spare parts. On recorded there. Credit side. After that, surely just balance it to your accounts. And that is it. As the end of paper number 1, May 2024. Let's look at the next one. So this paper now. This paper is Jan 2022. We're gonna do this one now. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. 2022. All right, this is which paper is this again? All right, January 2022. Let's go through this. 5 questions, 3 hours long. Yes, you're allowed to use a calculator. State one reason why a retail store should prepare a control account. Control account, suspense account, bank reconciliation, all of them helps you locate errors, helps you detect errors, right? They ask specifically for accounts payable, can help you find errors pertaining to your accounts payable. Can help you find errors in a purchases journal, help you find errors in a purchases ledger. Anything like that could work, right? So we know there's going to be a control account question. Right. Here they ask, the following information was extracted from the books of retail store owned by CT. And it says state one reason why the account receivable would have a credit balance. Because you notice at the start of the month, account receivable has a debit balance of 8,500, which it should, but it also has a credit balance of 65. Why would it have a credit balance? There's two main reasons why it would have a credit balance, right? One, they made an error. One of your accounts, they make an error, and it remains with a credit balance. The second one, and this is the one that they're looking for, is that there was an overpayment. So, for example, I was owing $1,000, or somebody was owing me $1,000, and they paid me $1,000. Better I'll show you a visual with the example. So let's see, I had this receivables account, right? Don't mind the lines, no straight. I'm sorry. Let's call this person Bob. This is Bob. Bob owed me $1,000. So Bob had a balance brought down of $1,000. Bob decides to pay cash $1,000. What he didn't realize is that he earned himself a discount of $100. So he was only supposed to pay $900, but he overpaid. He ended up paying $100 extra. Now, when I do the balance carry down and brought down for Bob, my balance carry down is actually going to go on the debit side, the smaller side. Balance carry down will be 100. I'll put my totals on both sides, 1,100, 1,100. And then my balance brought down is going to go on the opposite side of the carry down, which is going to be on the credit side. So because Bob overpaid, he ended up with a balance brought down on the credit side, even though he's a receivable. All right, so that is what I mean when I say there was an overpayment. All right, so either there's an error that caused it to happen, or there was an overpayment. There's one mark. Then they say additional information was taken from CT's books on the 31st of March. And they give us all the information we need here. And they ask us to use the information provided above to prepare the following ledger accounts. Balance the accounts appropriately at the end of the month. First one they ask for is a payables control account. So the payables control account, think of it as one big account for all your payables going into one place. Payables is a liability. When liabilities increase, you credit. When liabilities decrease, you debit. So anything that is going to make you owe your payables more, so it's going to increase, you're going to record it on the credit side. Anything that's going to make you owe your payables less and make it decrease, you're going to put it on the debit side. Now, just like with the cash book, a common mistake people make here is that they leave out the balance brought downs at the start of it. Look what they did. They put the balance brought downs all the way up here. Easy for you to forget about it. Don't let that be you. Very first thing you do is check for balance brought downs when you're doing your accounts. So the first thing I put in here in the payables control account was my balance brought down of 8,800. But this thing keep moving. Right. 1st of April, balance brought down 8,800 on the credit side. Very first thing I put in. So I start with my balance brought down of 8,800. Do not leave out your balance brought downs. Please, please. Right? Now, I'm going to go through these transactions. If it's related to debtors, I'm leaving it out because I'm only looking at my creditors right now, only looking at my payables. If it's making them owe, if it's making me owe them more, credit side. Making me owe them less, debit side. That's how we're going to do it. So the first one, cash received from debtors. That is debtors, none to do with payables. Ignoring that one. Second one, check received from debtors. Check received from debtors. Again, that is debtors, nothing to do with us. Third one, total checks paid to suppliers. If we are paying a supplier or creditors money, do we now owe them more money or less money? Anyone?
Less
If we
money.
pay less money. So this payment to suppliers will go on the debit side. $74,025. Credit sales. Sales are none to do with our payables. Discount received from suppliers. If they give us a discount, do we owe them more or less?
Less.
So again, debit side. 1450 on the debit side. Purchases. If we purchase from them on credit, do we owe them more or less?
You owe them.
Owe them more. You see how simple this is, eh? Do not overthink it. We owe them more, we pay it on the credit side. When liabilities increase your credit. Return outwards. If I return a good to you, do I have to pay you for it still?
No.
No. So it decreases. Return outwards, debit side. Bad debts, that's for your debtors. Dishonored check, that'll be a fair debtors. We're not going to be giving any dishonored checks. Return inwards, only customers can return goods to the company. That's not payables. Discount allowed, that'll be discounts we give to debtors. That's not going here either. So that is everything else. That is everything. So now I would do my balance carried down and balance brought down. But when I try to, I realize that both the debit side and the credit side are equal. So there's no balance carried down or brought down. And when I went back up, I realized that there was no closing balance for accounts payable, which means this must be correct since this has no closing balance. That was 6 marks. Now, time to do receivables control account. It's like a big account for your debtors. Debtors is an asset. When assets increase your debit, when assets decrease your credit. So if it's making them owe me more, I'm going to put it on the debit side. If it's making them owe me less, I'm going to put it on the credit side. Owe me more debit side, owe me less credit side. So again, I'm not forgetting my balance brought downs. I'll start off with balance brought down, 8,500 on the debit side and 65 on the credit side. Balance brought down, 8,500 on the debit side, 65 on the credit side. Now we know we used this, 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 this. So now we're going to look at everything else. Remember, for receivables control account, if it make them owe us more, debit side, if it makes them owe us less, credit side. Cash and checks received from debtors. If they're paying us what they owe us, do they owe us more or less?
Less.
Correct. So it goes on the credit side. Cash 250, bank 10,000. Credit side. Next one, credit sales for the month. If we sell people goods on credit, do they owe us more or less?
Less.
We sell them on credit, they owe us less?
Not way more.
Uh-huh. I know go to buy some stuff on credit from you. Right? So because they owe us more, we're gonna pay it on the debit side. Sales 99.75. Next one. All right, so we do this, we do this, we do this. Bad debts written off, 650. If I write in them off as a bad debt, do they owe me more or less? If I say, all right, I'm not gonna collect from this person again. Do they owe me more or do they owe me less?
Less.
Mm-hmm. So I record it on the credit side. Bad debts, 650 on the credit side. This on a check. So they would have paid me a check and I would have credited because they owed me less. But now that I find out the check is dishonored. So now they owe me that money again. Well, I kind of sell it out there. So they're going to be owing me more. So I'm going to debit my dishonored check. Dishonored check 55. Return inwards. If they return the goods, do they owe me for it still?
No.
No. So they owe me less. So I'm going to credit. And if I'm giving them a discount, do they owe me more or less?
No, less.
Less. So I'm going to credit that as well. So that's what I'll do here. Credit return inwards. Credit discount allowed. Now it's time to do our balance carried down and brought down. But wait. If I recall, they gave it to us already. So we're going to plug these into our control account. And both sides supposed to be equal, or else they make a mistake somewhere. So they say at the end of the year, we had a debit balance of 8,168 and a credit balance of 1,253. For this balance brought down to be on the debit side, where would the balance carried on be? If the balance brought down is on the debit side, the balance carried down will be where? Debit side or credit side?
Credit side.
Which side?
The credit side.
Credit side, correct. So when I do my balance carry down, I will put that 8,168 on the credit side for the balance carry down. And then for the credit balance of 1,253, the balance carry down will be on the debit side. So that's where I'll put it. And then I'll get my totals and pray that they match up, which they did, which means I put everything on the correct side. And then I'll put in my balance brought down. If the balance carried down is on the debit side, the balance brought down goes on the credit side. If the balance carried down was on the credit side, the balance brought down goes on the debit side. And that was the last 12 marks. Let's move on to number 2. Say the purpose of accounting. The reason we do accounting is to help users of financial information make better decisions. So I'm the owner of the business. I want to make sure I'm making profit. I could refer to the accounts to help myself make the profit or to make decisions. I'm a potential investor trying to decide if I can invest or not. I can look at the accounting and make a better decision on whether or not to invest. List 2 duties of the accountant. So much to choose from. You could say preparing financial statements, manage payroll, manage bank accounts, do bank reconciliation, prepare journals, budgets. Anything of the sort would work. Right. So you have to put the letter that corresponds to the ethical principle. The first one, accountants must not be biased, must not allow bias conflict of interest or undue influence of others to override their professional and business judgments. What ethical principle is that? Not allowing bias to affect the decision making. Nobody knows? That is objectivity. Not allowing bias to affect the decision making. The second one, accountants must not use accounting information for their personal advantage, for the advantage of third parties. Accounting information is supposed to remain private. Not supposed to use it for anything like that. Private or confidential. So C. To exercise sound judgment, accountants must stay abreast with the relevant laws, regulations, and technical standards. That is professional competence and due care. You can't be signing up to be an accountant and you can't remember how to do accounts. Accountants must comply with relevant laws and regulations and avoid any actions that discredit the profession. You can't make accountants look bad. That's professional behavior. Then also we have a payroll question coming up. They ask about statutory deductions. You know, there's two types of deductions, statutory and non-statutory. Statutory deductions are the deductions from your pay that are required by law, like national insurance or tax. Non-statutory deductions are voluntary deductions, like you're paying insurance or you're paying your gym fees, personal or private pension plans, stuff like that. Then they say James Bolo is a machine operator at Zimbo Construction Company. The following is Mr. Bolo's information for the year ended 31st of December 2021. Personal allowance. You gotta look at that. Income tax rate, information on the other deductions. When they said calculate his taxable pay, show or working. That's where the personal allowance comes in. The personal allowance is the amount of your salary that you do not have to pay tax on. The government gave you a blight. So I'm making 180,000, but I have a personal allowance of 18,000. It means I'm only paying tax on the remaining 62,000. That's what that personal allowance means. So when I'm calculating my tax, I'm going to be using that 62,000. In Trinidad and Tobago, the annual personal allowance is 90,000. That's a fun fact to know. Now here, they ask us to calculate the net pay. The net pay is a take-home pay. The gross pay minus all of your deductions. So start off with my gross pay, which was the 80,000. And then I'm going to minus all my deductions. First of all, minus is income tax. The income tax rate is 20%. But remember, I'm not calculating 20% of the entire salary. I'm taking 20% of my taxable income, which is my salary minus the personal allowance. So to be 20% of that 62,000 we just calculated, which is 12,400. Then we have the national insurance, and basically how to calculate these things, it just doing whatever the question tell you to. They say it's 5% of gross pay. My gross pay is 80,000. So my national insurance will be 80,000 multiplied by 5%. 4,000. They say the pension is 4% after income tax. So I'm going to take the 80,000 minus the income tax and multiply that by 4%. Well, what they tell me to do, that's how I do it. Contribution to health scheme, contribution to savings scheme, no calculation needed. Just list it out, add all of them up, give my total deductions, subtract it from my gross pay, and I get my net pay. 9 marks. Number 3. Patches Enterprises provides the following information regarding 2 non-current assets. First thing they want us to do, calculate the annual depreciation charge for equipment for the year ended 30th of April 2021. So you purchase it on the 1st of May 2020. So the end of 30th of April will be 1 year. They say equipment is depreciated over a 4-year period using a straight line method. The expected scrap value at the end of the useful life is 500. Straight line method is the cost of the asset minus the scrap value divided by the number of years of useful life. Right. So I'll take the cost of the asset, which is 18,500, minus the scrap value, which is 500. That'll give me 18,000. And then I'm going to divide that 18,000 by the number of years of useful life. It said it was a 4-year period. So I'm dividing it by 4. That'll give me 4,500. So each year is going to lose 4,500 in depreciation. Here now, they ask, use the information. Use the form provided below to prepare the extract showing equipment as it will appear in the statement of financial position for patches as at the 30th of April 2021. Not 2020, 2021. So I put in my headings. Fixed asset at cost, accumulated depreciation, net book value. under the cost, for the cost of the asset, 18,500. Under accumulated depreciation, I put the total depreciation. Only 1 year would have passed, so the total depreciation would be 4,500. The net book value would be the remainder. There's an extreme marks. Calculate that the amount that will be recorded in the books of Purchase Enterprises for the motor vehicle now. Let's go back up and see what they say about the motor vehicle. So it has provision for depreciation of 20,000. And it says vehicles are depreciated by 25% per annum using the reducing balance method. The reducing balance method, you take the cost of the asset, you subtract all previous depreciation, which will be in a provision for depreciation, to get a net book value, and then you multiply it by the depreciation rate. So in this case, it would be 80,000 minus the 20,000 multiplied by 25%. Which is what I did here. Calculated the net book value, 80,000 minus 20,000, and then I multiply it by 25%, the depreciation rate. Now, 3 marks. Use the form provided below to prepare the provision for depreciation account in the books, how to appear in the books of Purchase Enterprises for the year ended 30th of April. We want to balance it. So I would start off with a balance brought down of this 20,000. As it said, it had accumulated provision for depreciation of 20,000 from before. So I would start off with that as my balance brought down. And then all provision accounts, when they increase your credit. So the depreciation for the year, the 15,000 will go on the credit side. So I'll have my balance brought down on the credit side. The 15,000 depreciation we calculated will go on the credit side. Then I would balance it. Look for the smaller side, which would have been the debit side. Balance carried down will be 35,000. 20,000 plus 15. I put my totals. Then the balance brought down is on the opposite side of the balance carried down. 4 marks. Say the amount that will be transferred to the accumulated provision for depreciation on the motor vehicle account to the statement of financial position. The 35,000 was what will be in the statement of financial position, the total depreciation. Next one. Purchase Enterprises provided the following information for the year ended 30th April 2021. Sales gross profit, and then it's the expenses, it's 20% of sales. Use the data of Purchase Enterprises to calculate the amount On page 13, show working. Total expenses for the year. They said it's 20% of sales. So just take 650,000, which is the sales, and multiply it by the 20%. Simple as that, no headache. The net profit for the year, we have our gross profit, and we just calculated our expenses. So it's just gross profit minus expenses, and that'll give us our net profit. Again, don't overthink it. Then they said the percentage of net profit to sales. That formula is net profit divided by your net sales multiplied by 100. Again, linear ratios. I'm not saying it coming for sure. Just saying, just in case, make sure you know your ratios. Now is it? Number 4, errors question. I could be wrong, but I feel like either control accounts, errors, or bank records come in almost all the questions. All the exams, sorry. I could be wrong, that's how I feel. When most of them at least. The following errors were discovered after the preparation of a draft income statement on the 31st of December 2021 in the books of Jadi Park. They want us to correct all the errors, and they say we would have to put any narration. We just correct any errors. All right. First one, a credit purchase of goods of $670 for A Turi have been recorded at 607. Anybody can remember the name of that error? Anybody wrong amount? Nobody, boy?
Commission.
Commission is the wrong person's account. When you put the wrong amount, it's called error of original entry. All right, so you're supposed to put 670, but we put 607. Did we put too much or too little?
Little.
Too little, right? So to fix it, we're going to have to add to the sides. So purchases is always debited. We didn't debit enough by 63. So to fix that, we'll debit purchases 63. We are supposed to credit A to re. We didn't credit enough by $63. So to fix it, we're going to credit 63. Second one, purchase of furniture, 5,600 have been debited to the purchases account. So we put in it in the purchases account in error when it's supposed to be in the furniture account, right? So we debit purchases when we were supposed to debit furniture. So fix this, we're going to have to take it out of purchases and put it into furniture where it's supposed to be. How can we get it out of the debit side of purchases? By doing what?
The credit purchases and debit furniture.
Exactly. Credit purchases, debit furniture. Perfect. Just remember, any general journal, always put what's being debited first. Third one, closing inventory had been undervalued by 500. That's only affecting one account, inventory. When it's only affecting one account, that means it would have gone in the suspense account. The suspense account is used when the trial balance doesn't balance. If it's affecting one account, then the trial balance isn't going to balance. So to fix this, I need to increase my inventory because it was undervalued. So I'll debit inventory. And when you're fixing an error like this, the next side will just be the suspense account. So if I debit in inventory, I'm going to credit the suspense account. That was 7 marks. Then they say draw the park transactions in the month. Well, as follows, state one benefit of the trade discount and Mala Limited. You pay less money? No, later. No, we bought on credit from Mala Limited. Right, it will encourage us to buy more. Or to buy in large amounts. State one benefit of the discount to Jardy Parks. We pay less money. We save money. Next one now. We give us the following statement of financial position. Prepared by accounting student who is interning. And he makes some errors. Pressure. And I say use the statement of financial position to correct it and do it over basically. So I kind of put the answers here ready too. But as you could see, he had the bank overdraft in assets. He had joint in assets, which was one of his big first mistakes. He didn't have any separation for non-current assets and current assets. He just bulk liabilities and capital together. And he had no distinction for current liabilities and long-term liabilities. So we fixed that. We took our fixed assets, record them, get our total. Then we put our current assets together, which was inventory and receivables. And we minus current liabilities from it to get working capital. And we add that to our fixed assets. I got my first balance here. Then I separate my long-term liabilities and I add it to my capital. which will be my opening capital, add net profit minus drawings. However, if it's a loss, instead of adding a net profit, you'll minus the loss, like what I did here. Y'all, please, if you don't know your balance sheet format real good by tonight, when you go in the exam tomorrow, at least know it kind of good now. If all else fails, and you cannot remember your vertical balance sheet, at least remember your horizontal balance sheet and get some points now. A horizontal balance sheet follows the accounting equation A equals L plus C. You'll add up all your assets, get your total assets, add up all your liabilities, get your total liabilities, and add your liabilities to your capital. Your total assets is supposed to be equal to your liabilities plus capital. See, we can at least remember that one. A equals L plus C. Separate your assets between non-current and current. Separate your liabilities between non-current and current, and have your capital. Right. Right. Let's try to remember the basic format for the balance sheet at least. Number 5. Name one ratio that can be used to determine business efficiency. No, don't put current ratio. Put inventory turnover, receivables turnover, asset turnover, payables turnover. Any of those could come. Ratios come again. Again, I'm not saying it will come. Just saying make sure you know your ratios now. G&B Retail Limited provided you with the following list of balances which were taken from the books on the 31st of December 2021 at the end of the financial year. Use the appropriate information from the table above to calculate each of the two ratios below. In each case, state the formula used and show all working carefully. Asset test ratio. Formula for the asset test ratio is total current assets minus inventory divided by your current liabilities. So in this case, it would be 145,600 minus the inventory, 102,944 divided by your current liabilities. Whatever answer you get, put it as a ratio to 1. So if the answer is 9, the answer will be 9 to 1. If the answer is 0.2, the answer will be 0.2 to 1. In this case, the answer is 0.85. So you're putting it as 0.85 to 1. Return on capital employed is net profit divided by average capital. Right? So the reason why they call this capital at start. The average capital is the opening capital plus the closing capital divided by 2. It is actually not what should be here. So what I would do is calculate my average capital first. Capital at start is 700,000. And then my closing capital or capital at end is my capital at start, add net profit minus drawings. It have no drawings. So it'll be 700,000 plus the 140. 700,000 plus 140,000, which is 840,000. And then I'll calculate my average capital. which will be my opening capital plus my closing capital divided by 2. 700,000 plus 840,000 divided by 2. I know it's plenty, but this is actually the most accurate thing to do. 700,000 plus 840,000 divided by 2 will give us 770,000. Now to calculate the return on investment, it will be net profit divided by our average capital. So it will be the 140,000 divided by 770,000 actually, multiplied by 100. $140,000 divided by 770,000. Multiply by 100 and that'll give us 18.18%. That's actually a more accurate answer. Although I believe if you did it like this, you'll give any marks still. That's the ideal thing to put. Now they have G&B as the following information. Give us credit sales, credit purchases, accounts receivable, accounts payable. For all of these questions, you need to know your ratio formulas. No way around it. Use the appropriate information from the table above to calculate each of the time periods below. In each case, state the formula used and show all working clearly. So the first one, receivables collection period. The formula is a total account receivables divided by credit sales. If you're doing it based on how much, firstly, I'm going to start over. The receivables collection period calculates how long it takes you to get back your money from your account receivable. How long it does take you to get back the money that people owe you. The formula is account receivable divided by credit sales multiply by 365 if you want to get it in how much days. If you want to get it in weeks, you'll multiply it by 52. All right, so we use the 365-day formula here. So you take the receivables to the 7,256 divided by credit sales, 378,000, and multiply by 365. So the answer we got here is in days. It takes us about 36 days to get back our money. Then the payables payment period. This calculates how long it takes us to pay back people that we owe in. To calculate it, you take your account payable divided by credit sales, and then you multiply it by 365 if you want it in days, 52 if you want it in weeks. We put it in days again. So we take our accounts payable divided by our credit purchases, the 45,000 divided by 469,000 multiplied by 365. We got 35.02 days. It takes us approximately 35 days to pay back the people that we owe. Again, or they need to learn the formulas. Don't say I didn't say. Don't say I didn't say, because I know I say. Now they give us a stock valuation question. FIFO. FIFO stands for first in, first out. It means the first set of goods that come into the company is the first set of goods we selling. So it says, what is this? 5G&B Retail Limited sells a popular electronic device for toddlers called WePad. The following information is available about the item on the month of December 2021. On the 1st of December, we received 60 units at $20 each. 15th of December, we received 40 units at $22 each. And on the 19th, we received 75 units at $60 each. We sell, 75 units at $60 each. That $60 is the selling price. All right? They said use the FIFO method of inventory valuation to complete the inventory card below. So we start off on the 1st of December. We get 60 units at $20 each. That's what it said here. 1st of December, we received 60 units at $20 each. So 60 units came in at $20 each. So unsold units, we have 60 units at $20 each for $1,200. Then on the 15th, we bought 40 units again at $22 each. So we had 40 units coming in, $22 each. So for unsold inventory, we have the 60 from before because we didn't sell that yet. And now we get 40 more at 22. And then on the 19th, we sold 75. This is where that first in, first out comes in. The first set of goods that came in is the first set of goods we're going to sell. So when I sell 75, I take in from this 60 first. So that's 60 going out. So inventory out, that's 60 units at the price of $60. But remember, 75 units are selling all. So I still need to get 15. So I take in 15 from this 40. That's how I get 15 here. That adds up to the 75. So now that I sell this full 60, that full 60 gone, and 15 from this 40 gone. So what I have unsold would be the remaining 25 at $22 each, which come up to 550. That's how you do FIFO. If they ask for LIFO, it will be last in, first out. The last set of goods to come in is the first set of goods to go out. So if it was LIFO, I would have sold this 40 first, and then I'll get the remaining 35 from the 60. So I'd have been left with 25 units at $20 each instead, if it was LIFO. And that is the end of the paper. That wasn't too bad, in my humble opinion.
People estão moendo, tá me somando de futuro.
Let's hope. Let us hope. That's all we can do is hope. Let's look at June 2023 now. All right, this is June 2023. 3 hours. The accounts marathons is always the hardest, but these papers so long. Let's see. Yeah, him. A sole trader owns a printing firm called Yahim Printing Services. He has been recording his accounting information manually. Yahim intends to hire a bookkeeper to assist him with incorporating a software program into his business to make his workload easier and to improve his accounting systems. First thing they ask, identify one accounting software program. Sage Accounting, QuickBooks, that easy, Oracle, Bookkeeping, several accounting software. Just choose one, right? QuickBooks is one of the most famous ones. Sage Accounting, formerly known as Peachtree, it's another pretty famous one. Oracle is one that I know is used in a lot of companies. At least remember those three now. QuickBooks, Sage Accounting, Oracle. So you have three in your arsenal. Then it said identify one skill a bookkeeper should possess. Analytical abilities. Number one thing. Right? Computer literacy, communication skills, anything like that could work. Then they said the following table shows transactions that were omitted from the books. So it looks like they're gonna want us to record these. Let's see what they're asking for. Using the following general journal, record the transaction from the table onto page 4. Narratives are not required. So let's see. I have all the double entry rules on the side. Assets, when they increase, we debit. When they decrease, we credit. If it's a liability or capital, it's the opposite. When they increase, we credit. When they decrease, we debit. For the other account, we use the acronym known as PRIDE. PRIDE stands for Purchases, Return Inwards, Drawings, and Expenses. PRIDE is always debited. All the other accounts, sales, return outwards, and revenue, always credited. If you could learn this, you could record just about any transaction. The first one, bought goods on credit for 400 from R through. Remember, one account is debited, it means the other account is automatically credited. So when you buy goods, that's purchases. Purchases is debited, which means automatically we're going to credit R through. So you debit purchases 400, credit R through 400. Look at how we do it. You notice that big space there between the line and R through? That is not by accident. That is on purpose. When you enter in the credit entry in a general journal, you always indent. So the debit entry goes first of all, always. And then when you credit, you put an indent between the details and the margin. Second one, sold goods valued at 600 on credit to you, Moon. Sold goods would be sales. Sales are always what? Debited or credited? It writes on the board. Sales is always. Don't you all rush at once? Sales is always what? Debit or credit? Chelsea.
Sales is credited.
Right. So if we're going to credit sales, what are we going to do to you, Moon?
Debit.
Correct. Simple as that. Just remember, we have to put what's being debited first. So we debit you, Moon, first. Then we credit sales. And again, we put the indent. Third one. received an invoice from BWIC. If we receive the invoice, it means we purchased something and they're giving us an invoice. For goods worth 4,000, less a trade discount of 33 and a third percent. You do not record trade discounts. So I'm not going to have an entry for discount. I do subtract it though. So I'm going to calculate 33 and a third percent of 4,000, which will be 1,332. Well, they say 1,333, and I'll minus it from the 4,000. So that is 2,667. If I receive an invoice, that means I purchased the goods. Purchases are always what? Debited or credited?
Credited.
Purchases is always what? I didn't hear you.
Credited.
Not credited. If sales is credited and purchases is the opposite of sales, then purchases would be
Debited.
debited. Also, remember the acronym PRIDE. PRIDE. PRIDE is always debited. Purchases, return inwards, drawings, expenses. PRIDE. PRIDE. Always debited, right? So if we debit in purchases, what are we going to do to BVIC? If we debit purchases, BWIC will be what? Credited.
Credit.
So we debit purchases, credit VWIC. I'll leave out something. Yeah, well, I'll leave out the 12, yes? You moon return $50 worth of goods. I return inwards. Pride, purchases, return inwards, drawings, expenses, always debited. Which means return inwards will be debited, and you moon will be what?
Credited.
Credited. Correct. Last one. Goods returned to L son. That will be returned outwards because we are returning the goods. It'll be 120 less a trade discount of 20%. Again, you're not recording the trade discount, but you're going to calculate it. If you minus 20% of 120, you'll remain with $90. Return outwards is always what? Debited or credited? It's on the board.
Debited.
Is it part of pride? Return outwards.
Credited.
PRIDE is not part of it, right? Return inwards is part of pride, but not return outwards. So if it's not part of pride, that means it's credited. Look at right here. Return outwards, credit. If we are going to credit return outwards, what are we going to do to L son? Come on.
Debit.
Right. So you credit return outwards, debit L son. So see L son debit, return outwards credit. Used identify the source document that was issued on the transaction the 19th of April. The 19th of April was goods being returned. When goods are returned, you use the credit note. Then they say the following information is available for 3 of the employees of him printing services. First one is Leela. Leela annual salary is agreed at 84,000 for the year. Sim has agreed to give her 2% pay raise on her annual salary for the new financial year ending. calculate our gross earnings for the new year. All I do is add 2% to get a total annual earning. And since you want it for the month, I divide that by 12. Plain and simple. Next one now, Samsung. Samson is paid $30 per hour. Yahim has contracted him to work 35 hours per week. For the week ended 30th of April, he worked 49 hours. Oof. Overtime is paid at time and a half, time and a quarter. Kind of cheap thing is that about time and a quarter. So we need to calculate his gross pay, which will be his regular pay, which is $35 hours multiplied by 30. And then the remaining 14 hours overtime, you multiply that by 30 and then multiply it by 1.25. Once I calculate it, I'll add my basic wages to my overtime wages, and that'll give me a total of 1,575. Nice 4 marks. Let's see, last employee now, employee Dolly. Dolly earned a basic salary of 3,400 per month. In addition, she has paid commission 2% of the amount in which the revenue of the business exceeds 40,000 per month. For the month of April 2023, the company revenue was 58,000. Calculate Dolly's gross pay for the month of April 2023. Alright. The amount by which the revenue of the business exceeds. So the company revenue is 58,000, which means it exceeds it by 18,000. Because 58,000 minus 40,000 is 18,000. So we getting 2% of 18,000 plus again its basic salary. Then it said state 2 types of compulsory deductions that are normally deducted from employees' gross pay, national insurance, and tax. Anytime they ask you that, you're going straight to that. National insurance, tax. Right. Number 2, in a cash book here. And they wanted to know information about the cash book. Like the meaning of the balance brought down and stuff like that. The balance brought down on the 1st of April. That is the amount of money you had in the cash. So the business had $480 cash. Balance brought down in the balance sheet, in the bank statement column, sorry. It's on the credit side, which means what? There was a what? When you have a credit balance in your bank column.
It means there was a debit balance before.
Well, this one is you have a credit balance in your bank column. What does that mean?
A contra entry.
Mm-mm.
A overdraft?
Mm-hmm. When you have a credit balance, it's called a bank overdraft. State whether NILA consultancy services allowed or received a discount on the 15th or 1500 on the 15th. Discount allowed would be on the debit side. Discount received would be on the credit side. The 15th is on the credit side. So that will be discount received. Say 2 reasons why the check for ADFP PLC may have been dishonored. 2 main reasons: may have had an error on the check. To be fair, it have more than 2. The error may have had an error on the check. The check may have been damaged, or the person didn't have enough money in the account. Any of those 3. State the reason for 2 entries on the 28th of April. On the 28th of April, it had an entry in the bank column and an entry in the cash column. What you just call that again?
Contra entry.
Contra entry.
Right, that one is the contra entry. Man, there was a contra entry. Gosh, I'm speeding. Calculate the percentage discount on the 12th of April. Right, so $5,000 discount. And a bank $245,000, which means the full amount could have been $245,000 plus $5,000, which would be $250,000. So the discount will be $5,000 divided by the full amount, $250,000, multiplied by 100, which is 2. So the discount would have been 2%. Calculated the amount before the discount by adding back the discount. And then take the discount divided by the total amount, multiplied by 100. So just the reason why NILA Consultancy Services had to refund Kelima might have been an overpayment. Some of the goods were damaged, so they refunded some money to compensate. Anything like that could work. Calculate the yearly interest. The NILA services will pay for the bank loan on the 10th of April. Let's see. 12% bank loan, 60,000. Will be 60,000 multiplied by 12%, which is 7,200. Calculate the balances in Cashbook. State whether it's debit balances or credit balances. There's just a balance in Cashbook. To balance the cash book, you compare. It says the cash columns. Compare both cash columns. So you're looking for the smaller side, which will most likely be the credit side. For the last day of the month, details balance carried down, and the amount is the difference between both sides. So the total debit side minus the credit side gave us 1,950. Then we do the same thing for bank. Check to see which side is smaller, with 245,000 on the debit side. The credit side is definitely smaller. So we do the same thing. We put the balance carried down as the difference between both sides. Add up the larger side minus the smaller side. After we get our balance carried down, we put our totals. Our cash and bank column should be the same on both sides. And then on the first of the following month, on the opposite side of the balance carried down, we put the balance brought down. 1950 on debit side, 287,850 on the debit side. So that is what we put here. $1950 debit, 287,850 debit. Then it said complete the following accounts for the books of Nylock Consultancy Services for the month of April using the information in the cash book. Find this 20 for 3 marks. So actually so inconsistent with that. Anyway, so they give us the balance brought down. Everything related to K Lima, we put it into K Lima's account. So it actually stay right on K Lima account. In the cash book, it had that he paid. Actually, I'm going to the cash book. Right. We debit the cash book $20,000 under the bank column and $250 under discount allowed. That means we will credit K Lima that 200,000 to show that he owing 200,000 less, and that 250 discount allowed. We're showing he owing that 250 less. The next thing we have from K Lima is the refund, 1,600. If we credit the cash book, it means we debit in K Lima's account. Which is what we did. For the cash, any discount allowed on the credit side. And then the refund, debit side. Then we do our balance carried on and brought down. For the discount allowed column, it is taking the total discount allowed from the cash book, which will be 5,000 plus 250, 5,250. And you transfer it to the income statement. Say credit. And that is it. Number 3. Manufacturing accounts question. So the following information is available for Chevron Manufacturing Company. Give us a good bit of information here. They want us to identify 2 examples of direct costs used in the manufacturing of the product. In this particular product. So direct costs are costs that could be related directly to the good. The more of the good you produce, the more that cost would be. The less of that good you produce, the less that cost would be. So for example, if I'm paying workers $5 for every item they produce, If I produce 5, that's $25 out of fee. If I produce 10, that's $50 out of fee. If I produce none, I had to pay no money. Right? That will be a direct cost. It has to vary based on the amount of goods being produced. And that will be your factory wages, which is 60% of your factory wages, and your royalties. Royalties will be paid based on how much of the person's product you're making. So factory wages and royalties is good enough. Oh gosh, very good, very good. Oh gosh. What is saying doing this way? I ain't going all that far. Alright. See first to load up, right. Identify 3 examples of indirect costs in a manufacturing product. You can look at the part of the factory wages that is not direct. You could look at, I think they had general expenses. And what else? Let me see. Rates and insurance. So rates and insurance, general expenses, and the part of the factory wages. Using the information on page 15. Prepare the manufacturing account for the ending 30th April 2023. Push up on manufacturing cost showing clearly the cost of raw materials consumed, the prime cost, the total factory manufacturing overheads, and the production of goods completed for the year ended 30th of April 2023. Right. So your manufacturing account is easier than expected, trust me. It is adding a direct cost to your indirect costs, add opening work in progress, minus closing work in progress. And that is it, right? Your direct costs will be a direct material, direct labor, direct expenses. The only one you have to do a calculation for is a direct material. Once you can learn this calculation, you could do your manufacturing account because everything else is extremely straightforward. Your direct material, to calculate it, is just like your cost of goods sold. Cost of goods sold is opening stock, add purchases, add carriage inwards, less return outwards, less closing stock. It's the same thing. Just that you're going to use your raw material information. So instead of opening stock, it's opening stock of raw materials. Instead of purchases, it's purchases of raw materials. Add carriage inwards are raw materials. Less return outwards are raw materials. Less closing stock are raw materials. You do that, that will give you a cost of raw materials used. That is your direct materials. After that, you just have to add a direct labor and a direct expenses. A direct labor.
Take a go over the table, please.
Which table?
The factory inward
This?
tables. Yeah.
This?
Yeah. Yeah.
All right. So if you know how to calculate your cost of goods sold, which you're supposed to know. If not, please go and learn it. You can do this. A cost of goods sold. This is just a calculated direct material. So this is just this part here. Right? It's just like a cost of goods sold. Cost of goods sold is opening stock, add purchases, add carriage inwards, less return outwards, less closing stock. And you get a cost of goods sold. It's the same thing. It's called cost of raw materials consumed. Instead of opening stock, it's opening stock of raw materials. You add it to your purchases of raw materials. Add carriage inwards or raw materials, less return outwards or raw materials. Normally that will give you a cost of goods available for sale, but in manufacturing accounts, it is cost of raw materials available for consumption or available for use. Then you minus a closing stock, and that will give you a cost of raw materials used or consumed, just like a cost of goods sold. So this will be your direct materials. You'll just add that to your direct wages and your direct expenses, and that will give you a total direct cost, also known as a total prime cost. Your direct wages would be up. Here, a factory wages. They said 60% was direct and the rest indirect. So I'll take 60% of this 123,000, and that would be my direct wages. And then any other expense that you have to pay when you're making a product, the more you make, the more the expenses, the less you make, the less the expenses. That will be a direct expense. And one of the most famous ones they like to bring is this one, royalties. Royalties is when you have to pay the person who owns how to make the product. You have to pay them every time you make the product. Right, this will be a direct expense. So add those three up, and that will give you my total direct expenses, also known as my total prime cost. Add them up, give my total prime cost. Then I have to add my indirect costs. These are costs that do not directly relate to the making of the good. So it doesn't change based on the amount of goods you produce. For example, rent. If I'm renting a room for $2,000 a month to make the goods, it doesn't matter how much goods I make, my rent is still going to be $2,000 a month. So it's not directly related, but I still have to pay the rent to make the good, so it's still part of the cost. I'll add up all of my indirect costs, but remember it has to be related to the making of the good. So for example, where's the information? All right, for example, they said rates and insurance. The rates and insurance are apportioned 4-1 between the factory and the office. So the part that have to do with the office, I'm not paying that in the manufacturing account. Insurance for the office have nothing to do with making the good. I'm only counting the insurance for the factory. So I'll take 45,000 and I'll change that 4-1. I'll change it as a fraction. I'll multiply it by 4 and divide it by 5. So 4 plus 1, that will be my denominator, and 4 will be the numerator. So 4/5 will be for the factory, and the remaining 1/5 will be for the office. Just like when we sharing our profits in the partnership, how we change the ratio to fractions, we'll do the same thing here. So 4/5 of 45,000, I'll put in the manufacturing account. General expenses, 3,500 apportioned to the office and the remainder to the factory. So that 14,000, I'm going to minus the 3,500 for the office because that have nothing to do with making it good. So only recording the remainder, the 10,500. The 40% that is indirect, I'll record that as well. So I'll record my indirect costs, the same indirect costs that we just called out, add them up, give my total indirect costs. Add them up, give my total costs. The last thing you do is add opening work in progress minus closing work in progress, and you get your cost of production. So if you get a manufacturing accounts question, all you are doing is adding up all of your costs together. You're adding up your direct costs, get your total, add up all your indirect costs, get a total, add them together. And then you add your opening work in progress, which is the goods that you start making but you didn't finish making yet, and minus your closing work in progress. And that will give you a production cost. Look at it. The opening work in progress at the start of the year, 14,000. Closing work in progress at the end of the year, 29,000. So just try to remember, you need to add up your direct cost first, which is direct material, plus direct labor, plus direct expenses. In most cases, they will tell you what the direct labor is. They will tell you what the direct expenses is. The direct material, you're going to have to calculate. So you have to learn that formula. But it's just like the formula for cost of goods sold. So that should help you out. Opening stock purchases, add carriage inwards, less return outwards, less closing stock. After you add that up, get your total direct cost, which is known as total prime cost. You're going to add up all your indirect costs, which they call factory overheads. Any cost that is related to the factory that is not a prime cost is an indirect cost. Any cost at all, once you realize it related to the factory, it could be a janitor cleaning the factory. Once it related to the factory, it will be an indirect cost. You add them up, get your total, you add your direct cost and the indirect cost together. After that, you add the opening work in progress, which the question will give you, and you minus any closing work in progress, which the question would give you. Don't worry, you're almost finished. After this one, we will call it a night. I realize people feeding. Number 4, Brooklyn Sal is the owner of 2 companies, Brooks Technologies and Brookie Computer Supplies Limited. Brooks Technologies manufactures components used in the production of computer monitors. The forecast for sales for the components during each quarter of 2023 are presented as follows. So there's a sales forecast. We did a production forecast before. Now we're going to do a sales forecast. All right, so they expect to have... No. I think there's our next production forecast. What am I doing? What am I saying? Yep. You have to do a production budget. So again, when you're doing a production budget, this is what you have to take into account. How much you need for that particular quarter to sell, how much you need to hold as closing stock, and how much you already have as opening stock. Those are the 3 things you have to take into consideration. So this is the forecast for the sales, 6,000, 8,000, 12,000, 16,000. Brooklyn's policy is to maintain a closing inventory sufficient to cover 25% of next quarter's sales. Prepare a production budget for the first 2 quarters. So, I need 6,000 in the first quarter, right? I need 6,000 to sell. I'm gonna do this in a much easier way to understand than what I have here, right? Can do it in a much easier way to understand. So quarter one. I need 6,000 to sell in the first quarter. So I need to have 6,000. They say you must have 25% of next quarter's sales as closing stock. The next quarter's sale is 8,000. So I need 25% of 8,000 as closing stock, which is 2,000. So closing stock is 2,000. So in total, I need 6,000 plus 2,000, which is 8,000. That's the total I need to produce. The question says, that on the 1st of Jan, I had opening inventory of 1,500. So I need 8,000 in all, but I already have 1,500 in opening inventory. So the total I need to make is 8,000 minus the 1,500 I already have, which is 6,500. So I calculated the total I need, and I subtracted how much I already had from it to get how much I need to produce. Let's look at quarter two. Quarter two sales is 8,000. So I have to have 8,000 for my sales. And then I need to have 25% of the next quarter sales as closing inventory. The next quarter sales is 12,000. So I need to have 25% of 12,000, which is 3,000 as closing inventory. So I need 8,000 for my sales and 3,000 to keep as closing inventory. So in total, I need 11,000 units. However, last quarter, my closing inventory was 2,000, which means my opening inventory for the next quarter would be that 2,000. If I ended the quarter with 2,000 remaining, it means I start in the next quarter with 2,000 remaining. So although I need 11,000, I already have 2,000 in stock. So all I need to produce is the remainder, which would be the 9,000. Alright, so I got 6,500 here and 9,000 there. That is the answer. So whenever you get a production budget, that's how you do it. You start off looking at how much you need to sell for the year. Then you add how much you need as closing inventory to get the total that you need. And then you minus what inventory you already have to find out how much you need to make. So I need 50, but I already had 10. So that means I just need to make the 40 more. Next one now. The selling price of one component is $65. The total cost of producing one component is $50. Calculate the markup applied by Brooks Technology. So the selling price is 65, the cost price is 50. The markup would be the amount that they added to the cost price to get the selling price, which would be the $15. Alright? So they add $15 to the cost price to get the selling price. Because if the cost is 50 and the selling price is 65, they add $15 to it, right? To calculate the percentage of the cost that they added, They'll take the 15 that they added, divided by the cost, and multiply it by 100. Right? Markup is all about cost. Margin is all about selling price. Speeding. Right? We're almost finished. On the 31st of December 2022, Brooklyn discovered the following errors on the books of Brookie Computer Supplies. The first one, the balance of 12,436 for office furniture was recorded in the ledger of 12,364. They want us to complete the following table by putting text in the correct column to indicate if the effect on the error on non-current assets and profits for the year. So the first one, it was supposed to be 12,436, but we put 12,364. So we put less in error, which means it was understated. That is why they put understated in the non-current assets. But assets don't affect the balance, the income, the net profit. So it will have no effect on the net profit. Assets, liabilities, and capital are not going to affect net profit. The next one, an item of capital expenditure had been recorded as revenue expenditure. That would definitely affect it. Firstly, a capital expenditure is when you buy a fixed asset. So if you don't record it as capital expenditure, that means you're recording one less fixed asset. So that means you're definitely understating your fixed assets or your non-current assets. And then if you're going to record it as revenue expenditure by accident, that means you're actually going to subtract it from your gross profit to make net profit. So you're going to make your net profit smaller by accident. So you're going to be understating your net profit as well. See now, an item of capital has been overstated in the books of capital expenditure. That again, that's when you buy a non-current asset. So if you overstate it, they basically telling you it's overstated, but it's not going to have any effect in your income statement. Assets don't usually have effect to your income statement. So there'll be no effect. Then they said, identify two payment methods that Brooklyn can use to pay suppliers. They could pay cash. They could do a bank transfer. They could use checks. They could use digital wallets, whatever they want to use. Debit card, credit card. Then they say Brooklyn maintains a full set of books of accounts, the purchase ledger control account and the sales ledger control account are prepared at the end of every month. State 2 uses of the control account. It can not only locate errors, but it could be a form of internal control to reduce errors as well. So it can locate errors, it can reduce errors, it could simplify the ledgers as well by putting everything in one area, make it easier to find stuff. The following balances were extracted from the books. So it looks like it have an next control account to do. I'm not saying control account, bank rec, and errors has come out all the time. I just saying we just do 3 papers, and every paper at least one of them come. Sometimes 2 of them come. That's all I see now, but it's thrown out there. The following balances were extracted, and they want us to record the balances above as they would in the sales ledger receivables account. So we're looking at the sales ledger control account or the receivables control account. If it's making them owe us more, we are going to debit. If it's making them owe us less, we are going to credit. If we refund them, that means they had pay us based on something we owe and we give them back the money, so they owe us it again. So it's going to debit. Contra items transferred to the purchases ledger. This come like I owe boy, Chelsea $1,000, but Chelsea owe me $800. So we just say, hey, well, I just square it off. I will just owe you 200. It reduces the amount you owe, so that goes on the credit side. Bad debt, if I write you off as a bad debt, it means I no longer expect to collect from you. That's reducing how much you owe, credit side. Interest charge on overdue accounts. I'm charging you interest. That means you now owe me more, debit side. And that is it. One more question. A cooperative account. The following is a list of some balances which were extracted from the books of the Caribbean Teachers Cooperative Credit Union for the year ended 30th of April 2023. And give us all the information here. And they give us the following adjustments had not been taken into consideration and arriving at the surplus for the year. So yeah, so one thing to note, cooperatives, they don't use the words profit and loss. Instead of profit, they use the word surplus. Instead of loss, they use the word deficit. Alright, the following had not been taken into consideration and arriving at the surplus profit for the year. Building insurance expense had not been adjusted for prepayment of $500. Motor vehicles were not depreciated for the current year. The policy is to use the reducing balance method at a rate of 25% per annum. And the board of directors decided to transfer $12,000 to the Education Statutory Reserve Fund. The last one, they're not going in the in what we're about to do. This will go in the appropriation account. The last one is come like the same thing with company accounts. When you transfer into reserves, that goes in the appropriation account. Same thing here. Alright, so we're just looking at number 1, A and B for now. They say use the following form to prepare a statement of corrected surplus for the Caribbean Teachers Cooperative Credit Union for the year ended 30th of April 2023. So we make some errors when we calculated the surplus of 75,900. So we gotta correct them now. First error, insurance expense had not been adjusted for 500 prepayment. We would have normally subtracted that 500 from the insurance expense. And if we subtracted the 500 from the insurance expense, it would have made our insurance smaller, expense smaller, which means we would have been subtracting less, which would have increased our net profit. So to fix that, we're going to have to add that 500 because we minus 500 too much to calculate our surplus, not net profit. So we're going to add that 500 back. The next thing I have to do is calculate depreciation. The motor vehicles were not depreciated. The motor vehicle is $140,000. They said they're using the reducing balance method at a rate of 25%. So the first thing I will do, calculate the net book value. So I'm taking the motor vehicle at cost, minusing all the depreciation it had before, which will be in the provision for depreciation account, and that will give me my net book value. 140,000 minus 20,000. That will give me my 120,000, my net book value. And then I will multiply that by 25% to get my depreciation, and I'll subtract it. And that will give me a new surplus. Right, 4 marks. Then they will ask you to do an appropriation account. Yeah, if they're giving you a credit union, cooperative, they're gonna ask you to do an appropriation account. It's just like, it's almost exactly like the one for a company account. You start off with, instead of a net profit for the year, you call it surplus. So you start off with a surplus for the year. Then if you had any, same way in the company account, if you had any retained earnings from the previous year, is added. In this, if you had any surplus from the previous year that wasn't used, which they call undistributed surplus, you're going to add it. In this case, we had undistributed surplus on the 1st of May, 33,400. So we add that. Then we subtract any transfers to reserves. Now, if there's any dividends to be paid, they would pay it as well, but very often they opt to not have dividends, and instead they just reinvest the money into the cooperative. Because remember, the cooperative is created to benefit their members anyway. Right? So the more money they have, the more benefits they could offer. Right? So sometimes you'll get a cooperative question and it will have dividends that you'll have to subtract. And sometimes you'll get a question where there's no dividends. This is one of them. There's no dividends, and instead, there's just a transfer to the education reserve. Right. Here says a transfer 12,000 to the education statutory reserve, so I'm minusing that. And that will leave me with my undistributed surplus. 67,800. Not bad. Somebody who's not trying to make a profit, but. Then they say use the following information to prepare a classified balance sheet or classified statement of financial position in order of permanence. So it's going to show you it. It's very similar to company accounts, sole traders, etc. It just have one or two differences. So I'm just going to show you all the one or two differences and we will finish. So for one, we know our fixed assets, building at cost, investments, motor vehicle at cost. You see this here? Short-term loan to members. If that was a long-term loan to members, that would be a non-current asset or a fixed asset as well, right? But it isn't, so we will just look at these as a fixed assets. Your current assets now, you have a bank balance. You have, your bank balance, which will be the most obvious one. But then you have your short-term loans to members. Them owing you money, that's a current asset. And then membership fees due. That is people who pay in to be members of the corporation and they owe the corporation money. That's a current asset as well. The same way account receivable is a current asset, those are also current assets. So I would list short-term loans and membership fees as current assets. Liabilities now. None of this. It is accruals. It's on the credit side, which means it's a liability. And then we have member deposits, repayable at short notice. Now, remember it, I think I would have spoken about this sometime before. If I deposit money into the bank account, in my bank account, for the bank, when how they look at it, they now owe me that money. So for them, it's a liability. The same thing here. Membership deposits, they deposit money into your account, you now owe them that money. So it's considered a liability. Right. Capital section now. You take your share capital. Same way as add retained earnings to it when it's a company account. You'll add your undistributed surplus. You'll add your total reserves, which will be the reserves you have now plus the money transferred, just like with company accounts. Right. Everybody cool with that, right? So you take your share capital, add your undistributed surplus, you add your reserves, and that is it, just like with company accounts. So that's why it look like this. Alright, so to fully be able to do it, you need to be able to do your balance sheet. So you need to learn your balance sheet format. I really would rather you're not go into the exam tomorrow not doing your balance sheet format. There's a good chance it may not even come, huh? But just to be safe, now. Two things I would really want you to learn. If you could learn it before the exam tomorrow. Ratios, just in case. The ratios just in case. And your balance sheet format. If you could do that, that would be great. All right. I think I am going to end here. I realize a lot of people feeding. You're hearing me, right?
Yes, sir.
Yes, sir.
Gonna end here.